Silicon Valley Bank, a state bank and Federal Reserve member, opened its first office in 1983. It began operations immediately by filing with the United States Securities and Exchange Commission to collect funds from the public, with an unusual 100 founders on its S-1 form. This highlights two of the bank's major advantages: networking and marketing. They gained wide access to some of the Valley's greatest talent through their previous dealing. These technological entrepreneurs would not only invest in this bank, but they would also make deposits and refer others to it. This natural ability to rub shoulders with the vanguards of fledgling innovation was a central part of their strategy, which continues to the present. They also were aware that 100 founders would generate a commotion and attract onlookers due to the uniqueness of the number and quality of people involved. Soon more and more clients came through their doors and they were profitable almost right away. This appeared to validate their business model. However, they had to deal with the reason other banks weren't lending to these companies in the first place. They were too risky. Companies born yesterday, with a software idea, negative cash flow, and little more than a calculator in terms of collateral assets, appear to be high risk. While this may be the classic image of a new technology company, Silicon Valley Bank would argue that the technology sector is considerably more diverse. Although early-stage technology companies are a primary emphasis of Silicon Valley Bank, they only account for 6% of their loan portfolio, remaining 94% being non-early-stage borrowers. It is not enough to simply fund businesses, it is also necessary to fund expanding startups. The repayment of Silicon Valley Bank's loans is contingent on these firms continuing to operate and, thus, growing. This also means that oftentimes a startup that was nurtured by Silicon Valley Bank will feel comfortable banking with them as they grow. Thus the bank eventually finds itself with bigger clients over time. The non-early stage borrower magnitude indicates a mechanism for Silicon Valley Bank to diversify from early stage. This was part of its three-legged stool of technology, commercial, and real estate banking. Commercial banking would diversify away from early-stage lending, while servicing the different needs of clients who've grown into established firms. A unique feature of doing business with technology firms is that they tend to keep high deposits. Silicon Valley Bank has about $34 billion in deposits with a loans-to-deposit ratio of 42%, which is significantly below the average of about 75% of other banks. Keeping such large deposits would reduce profitability, thus Silicon Valley Bank would use the last leg of the stool, real estate, to offset this unique feature of technology lending. It would take part of those deposits and invest in real estate, but due to the cyclical nature of the real estate market, Silicon Valley Bank declared its first and only loss in the early 1990s. Silicon Valley Bank was not technically a too-big-to-fail bank, but it was still a major player in the financial industry. Its collapse was a stark reminder that the bank is too big to fail. The fallout from the bank's collapse was felt across the financial industry as investors and other banks began to question the stability of other financial institutions. That uncertainty saw over $100 billion lost from the stock value of global banks with its collapse. In the wake of the collapse of Silicon Valley Bank, U.S. President Joe Biden spoke with California Governor Gavin Newsom on Saturday to offer the full support of the government. In an effort to bring a sense of the calm to the industry, Biden assured the industry the measures put in place in 2008 by Obama administration will prevent a full-out collapse of the financial. One of the key measures is increased regulation. The government has implemented stricter regulations on banks, particularly those that are considered too big to fail. These regulations require banks to hold higher levels of capital and to undergo more rigorous stress testing to ensure their stability. The collapse has raised questions about the future of banking. Will traditional banks continue to exist, or will fintech startups replace them? Will regulation and oversight be enough to prevent future collapses? The answer is likely a combination of both. Traditional banks will continue to exist, but they will need to adapt to a changing financial landscape. Fintech startups will continue to disrupt the industry, but they will also face increasing regulation and oversight.